The phone call came at 3:47 a.m. on October 19th, 1987. Paul Tudor Jones had been waiting for it. His chief strategist, Peter Borish, was calling from their trading floor where computer screens glowed with cascading red numbers. "It's happening," Borish said, "exactly like 1929. By the time the sun rose over Manhattan that Monday morning, the Dow Jones would plummet 508 points, a 22.6% annihilation of value that would be remembered as Black Monday, the single worst day in stock market history. While pension funds evaporated and fortunes disintegrated, Jones sat calmly in his office, watching his net worth climb by tens of millions of dollars. He had seen it coming. More importantly, he had positioned himself to profit from the carnage. This is the pattern that repeats across every major market crash in modern history. While ordinary investors watch their retirement accounts hemorrhage value, a select group of traders, billionaires who understand the architecture of financial collapse, execute the same three calculated maneuvers that transform disaster into windfall. These aren't the polite diversification strategies your financial advisor discusses over coffee. These are the ruthless, contrarian positions that separate those who preserve wealth from those who watch it evaporate in real time. The strategies haven't changed since 1929. Only the players and the triggers evolve. The fundamental truth remains. Crashes are predictable, and they are extraordinarily profitable for those willing to bet against the crowd when euphoria reaches its apex. Jesse Livermore understood this better than anyone. Born in 1877, in a Massachusetts farming community so poor his family couldn't afford to keep him in school past age 14, Livermore walked into a Boston brokerage house and asked for work as a board boy, the lowest position available, chalking stock prices onto massive boards for traders to read. Within months, he had memorized the price patterns so completely that he began placing his own trades with money earned from tips. By age 15, he had accumulated $1,000, a small fortune for a teenager in 1892. By the time the stock market crashed in 1929, Livermore had become the most feared trader on Wall Street, a man J.P. Morgan himself would call, begging him to stop short selling because his trades were accelerating the panic that was destroying the American economy. Short selling is the first and most direct billionaire trade before every crash. The mechanics are deceptively simple. Borrow shares of an overvalued stock from a broker, sell them immediately at the current inflated price, then wait. When the price collapses, as it inevitably does when the bubble pops, buy back those shares at the crater price and return them to the broker, pocketing the difference. The beauty of the trade lies in its directness. You're not hedging, you're not diversifying. You're making an explicit bet that the crowd is wrong and that prices will fall. The challenge is that markets can remain irrational far longer than you can remain solvent. Timing is everything, and most traders who attempt this strategy get crushed when stocks continue climbing, forcing them to cover their short positions at devastating losses. Livermore didn't guess. He studied. Throughout 1928 and early 1929, he watched the market's behavior with the cold precision of a surgeon examining X-rays for cancer. Stock prices had detached completely from underlying business fundamentals. Companies with mediocre earnings traded at absurd valuations because everyone believed prices would keep rising forever. Margin speculation had exploded. Ordinary people were borrowing enormous sums to buy stocks, convinced they'd struck upon a path to easy wealth. Livermore had seen this pattern before in smaller panics and corners. He knew how it ended. So while cab drivers and shoeshine boys boasted about their stock market winnings, Livermore quietly built massive short positions across the most overvalued sectors of the market. When Black Tuesday arrived on October 29, 1929, the devastation exceeded even Livermore's darkest projections. The Dow plummeted 12% that single day, following a 13% collapse the day before. Panic selling overwhelmed the exchange. Traders screamed orders into telephones, their voices hoarse with desperation. Outside the New York Stock Exchange, crowds gathered in stunned silence as news of the catastrophe spread. Between 1929 and 1932, the Dow would ultimately crater 89%, dropping from 381 points to a skeletal 41. Livermore's short positions generated approximately $100 million in profit, equivalent to roughly $1.7 billion in modern currency. He had successfully bet against the entire American economy and won. But here's where Livermore's story becomes a warning as much as an inspiration. Despite his genius for reading markets and his iron discipline during the crash, Livermore would lose his entire fortune within 5 years. The same psychological vulnerabilities that destroy amateur traders, ego, emotional decision-making, failure to follow his own rules, would ultimately ruin him. By 1940, facing bankruptcy and crushing depression, Livermore would take his own life in the cloakroom of the Sherry Netherland Hotel in Manhattan. The lesson cuts both ways. Technical skill and market timing can generate enormous wealth during crashes, but psychological discipline determines whether that wealth survives. Fast forward 58 years to 1987. Paul Tudor Jones was studying the same patterns Livermore had identified, but with one crucial advantage: computerized data analysis. Jones and his strategist Borish had spent months comparing the market's 1987 trajectory to that of 1929, and the parallels were, in Jones's words, absolutely spooky. Both periods featured rapid run-ups driven more by momentum than fundamentals. Both saw increasing leverage as investors borrowed to amplify their bets. Both exhibited the telltale signs of speculative mania, the unshakable belief that markets could only move in one direction. Jones documented his analysis in a presentation that circulated among a small group of elite hedge fund managers. Stanley Druckenmiller, who managed George Soros's Quantum Fund, received a copy of Jones's work the Friday before the crash. Despite having just initiated a large long position, betting on rising prices, Druckenmiller immediately reversed course after reading Jones's analysis. That decision likely saved Quantum Fund from catastrophic losses. Jones didn't just short stocks, though. He deployed the second billionaire crash trade, put options. A put option grants its holder the right, but not the obligation, to sell a security at a predetermined strike price before the option expires. This creates an asymmetric payoff structure that becomes extraordinarily lucrative during crashes. Your maximum loss is limited to the premium you paid for the option, maybe $50 per contract, but your potential gains multiply exponentially as prices fall. During extreme market collapses, put options can generate returns of 10 times, 20 times, 50 times your initial investment within days or even hours. Jones had purchased massive positions in put options on major equity indexes, essentially buying lottery tickets that paid off only if the market crashed. On October 19th, those lottery tickets became winning jackpots. The 1987 crash differed fundamentally from 1929 in its cause and aftermath, and understanding these differences reveals crucial insights about modern market structure. By the mid-1980s, computerized trading dominated Wall Street. Program trading systems executed large orders automatically based on predetermined triggers. Portfolio insurance strategies, designed ironically to protect against downside risk, automatically sold stocks when prices fell. On Black Monday, these systems created a catastrophic feedback loop. Initial selling triggered stop-loss orders, which triggered more automated selling, which triggered more stop-losses. In a cascading amplification of panic that no human could control or stop. The crash began in Hong Kong during Asian trading hours and spread like a financial contagion through Europe, before reaching the United States. By the closing bell in New York, the Dow had lost 508 points in a single day, more than 22% of its value annihilated in 7.5 hours of trading. Jones's fund gained approximately 60% that year, with much of those gains concentrated in October. While competitors scrambled to exit positions and watched their capital evaporate, Jones sat calmly, watching his put options multiply in value as panic intensified. The Federal Reserve's immediate response, flooding the system with liquidity under Chairman Alan Greenspan, helped stabilize markets and facilitated a rapid recovery. Within 2 years, the market had fully regained all losses. But that V-shaped recovery didn't help the traders who had been forced to liquidate positions during the trough, or the investors who panicked and sold at the bottom. Jones's success came from positioning before the crash and holding his nerve when chaos erupted. 21 years later, in 2008, a relatively unknown hedge fund manager named John Paulson would execute what many consider the greatest trade in financial history. Paulson had spent his career in merger arbitrage, a specialized strategy involving companies being acquired, and had no particular expertise in real estate or mortgage-backed securities. But in 2005, Paulson became convinced that the housing market and the complex financial instruments built on top of it were headed for catastrophic collapse. Working with his analyst Paolo Pellegrini, Paulson studied the mortgage market with obsessive intensity. What they discovered horrified them. Mortgage lenders had abandoned all traditional underwriting standards. They were issuing loans to borrowers with terrible credit, insufficient income, no down payments, and in many cases, no documentation whatsoever. These subprime mortgages were then packaged into complex securities called collateralized debt obligations, sliced into tranches with different risk profiles, and sold to investors who relied on credit rating agencies that stamped 880A ratings on instruments that were essentially toxic waste. The entire structure depended on one assumption, that housing prices would continue rising indefinitely. Paulson recognized that this assumption was not just wrong, but catastrophically wrong. Housing prices had never risen nationally on a sustained basis, and the current surge was purely speculative. When the inevitable correction came, the entire edifice would collapse. Paulson proposed using the third element of billionaire crash trades, credit default swaps. These instruments functioned essentially as insurance contracts against debt default. Paulson could pay relatively small premiums to purchase protection against mortgage-backed securities that appeared safe, but were actually ticking time bombs. If the securities defaulted, the credit default swaps would pay out enormous sums. The strategy was brilliant in its simplicity and ruthless in its execution. Paulson established a dedicated fund specifically to exploit this trade and began accumulating credit default swaps on approximately $25 billion worth of subprime mortgages throughout 2006 and early 2007. The skepticism Paulson faced was withering. Goldman Sachs experts told him his analysis was completely wrong. Prospective investors questioned why he thought he knew more than experienced mortgage traders who had worked in the market for decades. Colleagues watched him pay premiums month after month on insurance against securities that kept performing. The carry cost, the ongoing expense of maintaining his positions, was substantial. If Paulson was wrong, or even if he was right but his timing was off, his fund would slowly bleed capital until it died. His investors grew increasingly nervous as 2006 turned into 2007 with no sign of the collapse he had predicted. Then the dam broke. In early 2007, subprime mortgage defaults began accelerating. Major lenders like New Century Financial collapsed. Bear Stearns revealed that 2 of its hedge funds heavily invested in subprime mortgages had lost nearly all their value. By summer, the crisis was metastasizing through the financial system. In September 2008, Lehman Brothers collapsed in the largest bankruptcy in American history. AIG, which had sold $447 billion in unhedged credit default swap protection, required a $182 billion government bailout. The entire global financial system teetered on the edge of complete collapse. Paulson's credit default swaps exploded in value. His fund made approximately $15 billion in 2007 alone. Paulson personally earned nearly $4 billion that year, more than $10 million per day, every single day, for 12 months. He continued profiting in 2008 and 2009, generating an additional $5 billion for his firm. All told, Paulson's subprime mortgage trade generated over $20 billion in profits. It remains the single most profitable trade ever executed by an individual in financial history. Gregory Zuckerman would document the trade in his best-selling book, and Michael Lewis would explore the broader crisis in The Big Short, cementing Paulson's reputation as a trader who saw the unseen and bet accordingly. The trade came with controversy. Goldman Sachs faced a $550 million penalty for its role in the Abacus deal, where the firm helped Paulson structure synthetic collateralized debt obligations designed to fail, then sold them to investors while Paulson bet against them. Critics argued that profiting from an economic catastrophe that destroyed millions of jobs and threw countless families out of their homes was morally repugnant. Paulson responded that he hadn't caused the crisis. Greedy lenders, reckless borrowers, negligent rating agencies, and captured regulators had created the disaster. He had simply recognized reality before others did and positioned himself accordingly. Whether you view Paulson as a visionary or a vulture depends on your perspective, but the effectiveness of his strategy is indisputable. Which brings us to 2025 and Liberation Day. On April 2nd, President Donald Trump invoked the International Emergency Economic Powers Act to impose a minimum 10% tariff on nearly all imports, with much higher rates targeting specific countries, most notably a combined 54% tariff on Chinese goods. Trump called it Liberation Day, claiming these tariffs would restore American manufacturing and reduce dependence on foreign production. Financial markets interpreted it differently, as an economic declaration of war that would shred global supply chains, ignite inflation, and potentially trigger recession. The selling began immediately. Within 4 trading sessions, the S&P 500 fell approximately 12%. The Dow Jones Industrial Average shed nearly 4,600 points. Global equity markets lost over $10 trillion in value between April 2 and April 9th. China retaliated with 34% tariffs on U.S. goods, escalating into what some analysts called a full-scale trade war, with tariffs ultimately reaching 125% on Chinese imports and 84% on goods from the United States entering China. The speed and severity of the collapse shocked even seasoned traders who had lived through 2008 and multiple flash crashes. But sophisticated investors who had recognized the warning signs, overvaluation in technology and artificial intelligence stocks, mounting concerns about U.S. fiscal sustainability, the predictable economic impact of comprehensive tariffs, had already positioned short positions ahead of Liberation Day. These traders watched the chaos unfold with the same calm calculation that Jesse Livermore displayed in 1929. Paul Tudor Jones exhibited in 1987, and John Paulson demonstrated in 2008. While amateur investors panic sold at the bottom, locking in devastating losses, the professionals who had shorted overvalued equities and purchased put options saw their positions multiply in value. Then came the whipsaw. On April 9th, Trump announced a 90-day pause on tariffs for countries that hadn't retaliated, sending markets soaring. The S&P 500 recorded 9 consecutive daily gains by May 10th, recovering all losses from Liberation Day. By June 27th, the index had surpassed its previous peak, closing above 6,173. This violent reversal created a second wave of opportunities for traders positioned correctly. Those who had profited from the initial crash by holding short positions and put options could now reverse their trades, buying stocks at depressed prices and riding the recovery wave upward. The ability to profit from both the collapse and the rebound separated elite traders from those who simply got lucky on one leg of the move. The third billionaire crash trade, rotation into safe haven assets, played out dramatically during the 2025 crisis. Gold, which had been consolidating after years of modest performance, exploded upward. As of late November 2025, gold trades above $4,000 per ounce, having gained over 50% year-to-date, making it one of the top-performing major asset classes worldwide. During the initial Liberation Day crash, gold surged 25% as investors fled to the precious metal that has preserved wealth for millennia. Even after pulling back slightly as markets stabilized, gold remained dramatically elevated, reflecting structural changes in demand. But something unusual happened with the traditional safe haven of U.S. Treasury securities. Initially, Treasuries rallied as expected when the crash began, with investors fleeing to safety. Within days, however, the bond market behavior became alarming. Treasury prices fell and yields rose sharply, particularly on long-dated bonds. This sell-off in treasuries shocked analysts who expected continued buying. The unusual behavior reflected growing concerns about U.S. fiscal sustainability. Trump's massive tax cuts and spending increases fueled fears of runaway debt. Foreign buyers, particularly China and other major holders of U.S. debt, began reducing their treasury holdings. For the first time in years, sophisticated investors began pricing sovereign risk into U.S. bond markets. This explains why gold prices jumped even more dramatically during the 2025 crash than during previous crises. When even government bonds become suspect as safe havens, investors flee to the ultimate store of value that requires no government promise, no corporate guarantee, no trust in any institution. Gold simply exists, scarce and indestructible, the same store of value that protected wealth during the fall of Rome, the collapse of Weimar Germany, the dissolution of the Soviet Union, and every financial crisis in between. Ray Dalio, founder of Bridgewater Associates and one of the most successful hedge fund managers in history, recently increased his recommended allocation to gold to 15% of portfolios, up from his previous 1 to 2% recommendation. Dalio cited rising U.S. debt burdens, with the government expecting to borrow $1 trillion in Q3 2025 alone, and long-term currency devaluation risks. Central banks worldwide have intensified gold purchases, marking one of the strongest official buying streaks in modern history. When central bankers who can literally print money choose to accumulate gold, it sends a powerful signal about their confidence in fiat currencies. The pattern repeats with eerie consistency across every major crash. Those who recognize the warning signs early position themselves against the crowd and maintain the psychological discipline to hold their positions through criticism and temporary paper losses emerge from crashes not just unscathed, but substantially wealthier. Jesse Livermore made $100 million in 1929 by shorting overvalued stocks when everyone else was buying. Paul Tudor Jones made 60% returns in 1987 by purchasing put options when everyone else believed program trading had eliminated market risk. John Paulson made $20 billion in 2007, 2008 by buying credit default swaps on mortgage securities when everyone else believed housing prices could never fall. Traders who shorted tech stocks and rotated into gold before Liberation Day 2025 watched their wealth multiply, while others suffered catastrophic losses. The psychological challenge cannot be overstated. Going against the crowd when markets are rising and euphoria prevails requires courage that few possess. Paul Tudor Jones consistently went against consensus, understanding that real edge lies in spotting when everyone is wrong. Jesse Livermore emphasized that hope and fear, the two dominant emotions in markets, destroyed most traders. Hope caused traders to hold losing positions too long, while fear caused them to exit winning positions prematurely. John Paulson faced months of ridicule from Wall Street experts who insisted housing prices could not decline nationwide. Maintaining short positions through criticism and temporary losses required extraordinary conviction. As of November 2025, multiple warning signs suggest elevated risks. Technology stocks, particularly those linked to artificial intelligence, trade at price-to-earnings multiples reminiscent of the 2000 dot-com bubble. U.S. government debt continues expanding rapidly, with projections of $12 trillion in new Treasury issuance over the next several years. Trade policy uncertainty persists despite markets recovering from Liberation Day. In October 2025, Trump announced plans for massive increases in tariffs on Chinese imports, triggering another sell-off. The VIX Volatility Index reached 27.8 in late November, a 50% increase for the month and its highest level since the April Liberation Day crisis. Jamie Dimon, CEO of JPMorgan Chase, announced concerns that stock prices could fall sharply within the next 6 months to 2 years, citing geopolitical uncertainties, government spending, and high valuations. The pieces are in place for another crash. The only questions are when it will arrive and who will profit from the inevitable chaos. Markets will crash again. That much is absolutely certain. The question facing every investor is whether they have positioned themselves to survive and potentially profit from the turbulence ahead, or whether they'll join the masses watching their wealth evaporate in real time while a select few execute the same 3 trades that have protected and enriched the financial elite through every major collapse of the past century. The billionaires who profit from crashes understand one eternal truth. Whatever happens in the stock market today has happened before and will happen again. They position themselves accordingly. The only question is whether you will too. The phone will ring at 3:47 a.m. The only question is whether you'll be the one making the call or receiving it.